You should all have access to the papers of the meeting, which are published on the County Council website. The meeting is being broadcast live via YouTube, and it will also be available for viewing following the meeting. So the first item on the agenda is item 1, the minutes. I move that the minutes of the meeting held on the 13th of December 2021 be approved. Is that agreed? Yeah. Fine, that's agreed. Item 2, question time. We have not received any questions. Item 3, questions asked by members. We have no questions. Item 4, there are no urgent items. Item 5, declarations of interest. Does anyone have any declarations of interest to declare? No, that's fine. So on to the first substantive item, which is the Pension Fund Annual Report and Accounts 21-22. So that's on pages 7 to 102 of the agenda pack. Declan Keegan, Assistant Director of Finance and Strategy, Ian Howe, Pensions Manager, and Bhulesh Karcher, Senior Finance Analyst, will talk through the presentation on the annual report and accounts, and Kat Chewy will update us on the fund's draft net zero climate strategy. This will be followed by a question and answer session. So, Declan, over to you.
Thank you, Chair. So we'll just give you a quick run through sort of the main, points that are covered in sort of the annual report, but not quite as lengthy. You'll be sort of pleased to hear. So basically, I'll start off with a quick overview of the LGPS. Ian will then pick up how it operates locally and then get into how the administration of the scheme's working. Bhulesh will then pick up the investment side of things, how it's performed, where we're investing at the moment, and then finally kind of Kat will round it off with responsible investment, which is essentially what we do to try and ensure that we're investing in good companies. Pass on to the next one. So first off, just picking up the local government pension scheme. And it's kind of, I suppose, after salary, it is the most valuable benefit most people receive in sort of their employment. And locally, we've got very, very little sort of discretion about the rules of the scheme. The scheme itself, mainly the benefits and the employee contribution rates are set at a national level. And those benefits themselves at the moment, for every sort of day we work, we're earning our benefits based on our average salary in the year. Although significant amounts of benefits are still linked to people's sort of final salary that was earned by people sort of a few years ago, but a lot of those people are still in employment with the scheme as well. So that gives the employees a huge amount of sort of certainty about what benefits they're going to get at sort of when they do come to the retirement age, but the risk or the financial risk all sits with the employer. And that's kind of where the fund comes in, really. We exist to help the employer with the affordability of those pensions when they do come in the future, making sure they're putting those, both employee and employee contributions, to work well. And I'll pass on to Ian now. I'll give you a bit more of an idea how we've sort of the arrangements got in place for that to work locally.
Good afternoon, everybody. It's Ian Howe, Pensions Manager. So I'm going to do an introduction to the Leicestershire Fund. So we have. I don't know if you can see that very clearly on the slides, but there are two governance areas. We have the Local Pensions Committee, chaired by Councillor Barclay, and the local government, the Local Pensions Board, chaired by Councillor Page. The committee tends to deal more to do with the investment side of the pension scheme, and are there to ensure effectively enough income is being generated from the investments to guarantee to make payment of the benefits to the scheme members. Within that, they have the regular meetings. There's 4 meetings a year, and then there's a 5th meeting to do with the investment strategy directly. On the board itself, that's more really to do with the administration, and it helps the admin authority ensure that it's meeting its responsible administration requirements, and that's, as I say, dealt with, chaired by Councillor Page. And again, there's four meetings a year. So what are the main duties of the administrating authority? So we're here to calculate and pay all the types of the pension scheme benefits. got a list of some examples of the things we do. We deal with the new starters joining the scheme from the various employers. We have approximately 180 employers in the pension scheme with active members. We calculate estimates for scheme members who are thinking of retiring or maybe transferring out. We deal with new employers joining the scheme. That's a very significant area of work in the section. There's always new joiners and new employers joining the scheme, often following TUPE transfers where work is outsourced by employers, and those scheme members' benefits are then protected under the new employer. Regulation changes. The regulations are fairly static, but they do change from time to time, so we have to ensure that we're always following the regulation changes. Year end, every year we work through the year end process with the employers to guarantee to get the annual benefit statements out to our scheme members by the statutory deadline of the 31st of August. The valuation is every 3 years, and that is to assess the value of the fund and to calculate the employer contribution rates, which is dealt with by our fund actuary, who are later in the on the agenda, and they'll be doing a presentation about this year's valuation. And then there's the governance, the reports to the board as part of the annual report. In terms of the fund statistics, this just gives you an indication, or shows you the change to the membership between 31st of March 21 and 22. So you can see in terms of active members, they're members who are still currently contributing to the pension scheme. There's been a small increase in active members. Preserved members are people who were in the pension scheme but are no longer paying into the scheme, but are not yet old enough to have actually claimed the benefits. They're called preserved members. And again, there's a slight increase in preserved members in the year. And then pensioners, people in receipt of their pension, a fairly high rise in pensioners. So the total in membership now is 19, or as at March 22, 99,240. So we're getting very close to the 100,000 value in terms of membership. This slide here shows the kind of the change over the last year since 2017 to 22. And it's quite interesting slide in terms of the membership. So you can see the active contributors, the blue line at the top. That's obviously the highest and continues to rise, but not as quickly. It's beginning to tail off. It's becoming more of a flat line. The pensioners, the line that starts at the bottom, that is going up pretty regularly year by year, and it's increasing quite considerably from where it was at 2017 to where it is now. You can see there's a substantial increase in pensioners. And the preserved members, those members who haven't yet claimed the benefits, they're fairly flat. They've been flat now for pretty much the last few years, really. There's been little change in preserved membership. So these were the statistics in terms of the year up to the 31st of March 22. So these were the benefits and changes that were made by colleagues in the pension section throughout the year. So we had just over 7,000 new starters, just over 2,000 retirements and 2,000 preserved leavers. Deaths, just about 1,200 or thereabouts. Refunds, 1,100. Transfers in and out, around about 300, and estimates, 1,200. That's a pretty standard sort of set of numbers. That's been pretty static in terms of our sort of level of work that comes through the section each year. We then measure what we call the KPIs, the key performance indicators. And we have two sets of KPIs split between the business processes and the members' customer feedback. These are the business processes, and we have three. So the retirement benefit notifications to members within 10 working days. So within the year, we tried to target 92%. That is our target to achieve. And we made 89%, which was just slightly below the target, but still a good number. Pension payments made to members within 10 working days of receiving an election, we hit exactly the 95%. And this is the other set of KPIs we measure, and this is on the customer side. This is the customer feedback that we get, and we request customer feedback each month, and we record this information. I don't propose to go through every one line by line, but you can see that pretty much all of them were above target. One or two were just slightly below, but again, all good numbers and all up in the sort of the 90% quartile. So we're happy with those. And again, good work and credit to the pension section colleagues for the work they've put in throughout the year. Just briefly looking ahead, I've picked 4 areas. Pensions administration doesn't stay static. There's always something going on. It's always a busy section. And I've picked 4 areas. The first one is McLeod. Then I've picked member self-service, administration processes, and something called the pensions dashboard, which is probably the one that is most likely to be the new one for most colleagues who might be listening into this. So McLeod, this is the national exercise that was brought about following the Court of Appeal, where they found the scheme to be unlawful on the grounds of age discrimination. And what we've been doing since around about 2018 is working with the employers on collating the missing service, and that's the service to backfill into members' records to allow us to rerun benefits between 2014 and 22. That's the period in question. And then those benefits that will then become higher, and we will then do revised benefits for those members. It's a huge exercise. It's absolutely enormous administrative exercise. The difference to members we think is going to be quite low, and I don't think that many members will actually be ultimately gaining from this exercise, but we've still got to go through the exercise to prove that we've completed it for each of the members in the scheme. The employers are working really hard on this as well, providing the information. We've had information in, I think, from around about 170 of the employers. We've got about 10 employers that haven't yet sent anything through, but we're still working on those. But the vast majority of employers have provided information, and we're working through those. But it's a really large exercise, the McLeod exercise. Member self-service. This is the further development of the fund's member self-service system. This allows members themselves, scheme members, to actually go online and look for information, but do their own estimates. Run their own retirement benefits and things of that nature. It also allows them to see things online for things like their annual benefit statements, and helps speed up the process in terms of things like the retirements. We've got an online retirement process now where the retirement can all be done online. The flow of information is electronic as well, which is quicker, helps with more secure transfer of information. And as we know, we're in the period at the moment with postal strikes, so things like that, it speeds up the process in transferring information across to us. Other online processes are being developed, and this is an area that we're continuing to develop and push ahead with. Bulk admin processes. We're keen to develop this further. We did a little bit of this last year, and it's still in the fairly early stages really, but it's something we're keen to develop further. Rather than run an individual calculation case by case, it allows you to clump cases together and run them as groups. That actually helps with the administration, because obviously you're getting more results through in one go rather than case by case. What we are finding is you have to do a lot more data checks, checks on the data to ensure the information is accurate before you then run them. And if you do run them, it then throws out some sort of warnings and things like that you have to check before you can go through. But principally, it's an area that we feel will help us administratively. So we're keen to press ahead with those. And then dashboards. This is the one that may be more newer to most members. This is the new national exercise to improve the overall member pensions experience. So what will happen effectively is people will have a single sign-in, and they'll be able to view all of their pensions in one place. This is known as the dashboard. So you'll be able to, a person will be able to go into the national dashboard and view all of their pensions. So if you worked for, say, Boots and and local authority, you'd have both your benefits from Boots and the local government scheme on there. The data is then pulled through automatically, and including obviously hours when we've signed up to it. We hope that it will actually increase members' awareness of self-service as well, and increase our overall membering online offering too, because more people will become aware of this. What we do expect is it will increase some of the administration as well, because there'll be more people asking more about their benefits, which is a good thing because people will be more engaged. It's due to go live in 2024, so it's still a while off, but there's a lot of work to be done before we get to that point, as you can imagine. So that's where we are with dashboards. I'm now going to hand over to my colleague Bulash to talk about the investments.
Thank you, Ian. Hi, I'm Bulash. I'm Senior Finance Analyst for the fund. The first slide we've got is the fund's current investment goals. We've got a number of bullet points on there. The first one there is the long-term view of investments is really long-term, circa 20 years. We have investments within the fund which are very liquid and we can draw on dead quick, but we've got other investments within the fund which lock up our money for a long time. That suits our fund, given it's a long-term investor. Second bullet point talks about the responsible investment theme. Kat sitting to my right here, we'll talk about that a bit later, so I won't touch on too much of that at the moment. We take a balance between long-term returns and risk, and we assess this annually with the fund's advisor, Hymans, who present and propose to the committee once a year, normally in January. The fund has considerable diversification. We'll look at that in a few moments as well. We invest in various asset classes, and therefore we should be a kind of all-weather investor, so we should be able to perform in most markets. We do have a preference in investing with the pool. We'll talk about who the pool are. Our pool is LGPS Central, and investing with established external institutional managers, so established meaning ones that the fund is aware of, has invested with previously. Just to give you a scope or an idea of this kind of size, the fund has around circa 20 managers investing in all the areas you'd expect, from listed equity all the way down to derivatives and hedging currencies and all sorts. We've got a continued commitment to asset pooling, like I said, ESG goals, that's environmental, social, governance goals, and generating cost savings. A little line at the bottom there talks about the size of the fund. So as at the 31st of March 2022, it was valued at 5.8 billion, and you can see the last few years previously. So it's had a good run over the last 3 years. A little pie chart to talk about where the funds are invested. So as at the 31st of March 2022, that 5.8 billion was largely split across 3 asset groups, we'd like to call them. So growth assets, income assets, and protection assets being the smallest. And we've got a little slither there of cash and hedge, which we try to keep as low as possible. That growth assets piece then in kind of lightish green at 61% nearly, represents all the kind of things you'd expect. So they're things like listed equity, private equity in the main. It's slightly overweight. We expect that to be a few percentage points lower. And the next slice there, the income assets, we expect to be slightly higher. So that was underweight, and we tried to rebalance that. We'll talk about that a bit later in the set of slides. The income element involves or invests in things like property, infrastructure, private credit, emerging market debt, and the protection slice there to kind of help us smooth out any volatility, and market turbulence includes things like UK index-linked bonds and high-rated government and corporate bonds. A slide that talks about the last few years' investment performance. We've got the top bar graphs looking at 5-year discrete annual performance, and then we've got underneath that, we've got the cumulative performance. So the thing to look at there is we can have really lumpy performance, in line with global markets. So what we try and do is we've got a really diverse mix of investments to help us smooth that. But you can see that in the bottom graph better. So we've got that first block, which is light green and blue. So you've got a 1-year, 3-year, and a 5-year, and you can see how relatively smooth they are when you strip out their kind of annual discrete performances. You can see in the table over there, we've had a year 1920, we had a minus 4.3, followed by a really good year 22, and followed by the final year 11.4%, which took us to the 31st of March 2022. I think the thing to kind of take away from all of this is, although we've had really robust performance over the last few years, The future certainly feels a bit tougher. And since the 31st of March, the fund hasn't seen the same returns we've experienced to date. I think we've had circa 5%, minus 5% from April to September. So it is really important to look at kind of long-term returns. A one-year view isn't really meaningful given the kind of time period that the fund invests in. Should we move on one? We talked a bit earlier about LGPS Central and asset pooling. So this is a quick slide to say LGPS Central is the pool that the fund invests in. It's partly owned by the County Council's pension fund alongside other central local authorities. So, ranging from Nottinghamshire down to, say, Shropshire and a few others. It's the first port of call, I think, when we're looking at the needs of the fund. So when we do have a need to invest in, say, infrastructure, we look at the kind of things that are available with LGPS Central. We're as a shareholder and the client, we're able to influence the kind of development of the products that they have. We can shape their ESG goals. And after a number of years of launching products, Central manages a significant portion of the fund. It is by far the biggest manager that we now invest with, and we should start to get the benefits of investing with somebody that we have a share in and speak to regularly. Talking earlier about the size of that manager, it represents nearly a third of all the funds we invest in now. 17% also is with Legal & General. That's a low-cost passive tracker. So kind of taken together, we have nearly half of the fund invested with two managers at really low cost. We can see on that pie chart there the kind of the makeups of 32% is the central funds, 17% with Legal & General, and we've got another circa half of the fund with legacy managers and managers that we need to have within the fund to kind of get the diversification. Got a list of bullet points down the side there which talks about the 10 products that we invest with Central. We've got two active equity funds and a passive equity fund which represent nearly 1.6 billion. We've got two private equity vintages, and we've committed 40 million to that over a number of years. A lot of that is still uncalled, so as that gets requested by LGPS Central, our level of pooled funds will increase. Likewise, you can see the rest through there. So we've got infrastructure, private credit, emerging market credit, multi-asset credit, and investment grade credit. The 232 million that you see there of uncalled funds will increase that kind of the 32% that we have with Central by circa 4%, everything else being equal. This last slide here talks about the developments that the fund has made since the 31st of March 2022. So this, that would have been the cut-off date, but it's just to give you an idea of the kind of rebalancing the funds had to make. I mentioned earlier that we're slightly overweight within the growth assets. You can see the kind of investments that we've made there over there on the right of that slide. So in April, July and October, we made a number of commitments to managers to kind of rebalance away from some of the growth areas and kind of top up that income area that we were slightly underweight at. I don't have any other slides there. Shall we move on to Kat?
Yes, good afternoon. So I'm Kat Toohey, Responsible Investment Analyst for the Pension Fund. So I'll briefly just take you through some of my slides. So first off, I suppose, how do we define responsible investment? So the Pension Fund defines it as an approach to investment that aims to incorporate environmental, social and governance factors, also known as ESG, into investment practices. Obviously, Bhulesh has kind of mentioned that briefly, but if we take these in turn, so environmental factors, these might relate to climate change, resource depletion, waste pollution, deforestation, biodiversity. So clearly where these factors aren't managed, they will seriously affect the world in the future. And then on social factors, so these might relate to human rights, modern slavery and child labour and working conditions. And then we also have governance issues. So this might relate to bribery and corruption, executive pay, board diversity and structure, as well as tax and political lobbying. So clearly important if we kind of look to protect and support companies' governance, it will have a huge impact on its ability to succeed and prosper. And as you can probably imagine, a lot of these factors are very cross-cutting. So why are these considerations important for the pension fund? So ultimately, if we incorporate these factors, it allows the fund to better manage risk as well as help generate sustainable investment returns. And we see this through research that indicates engagement with companies on ESG issues creates value for both investors and the companies by encouraging better ESG management and more sustainable practices. So it's important to say it's not the same as ethical or moral investing, which might have a primary purpose. And there's no requirement to invest in a specific strategy or product for ESG matters. Really, we just need to make sure we include ESG information in all investment decisions, as well as our stewardship practices and engagement with companies. And that will just ensure the fund is considering all relevant factors within while assessing risk and return. So in relation to our stewardship practices, the fund has a strategy of active engagement with companies to improve their ESG factors. While on our own, we're relatively small in the investment universe. We collaborate with our partners, such as the Local Authority Pension Fund Forum, and they cover assets of 350 billion within the same kind of local authority pension scheme. And they directly engage and escalate action with companies to deliver reforms that advance corporate responsibility and responsible investments. And as Bhulesh said, we're part of a pool, so LGPS Central have set 4 key engagement topics that they've agreed with our partner funds, and that's climate change, plastic, fair tax, and human rights risks. And we've delegated, well, the local pension committee has delegated the exercise of voting rights to investment managers on the basis that voting power will be exercised by them with the objective of preserving and enhancing a long-term stakeholder value. And so LGPS Central, as well as LGIM, they actively vote on our behalf, and they work with Hermes Equity Ownership, who are a leading stewardship provider for both, and then for both LAP, the Local Authority Pension Forum, and LGPS Central, we receive quarterly reports on progress and engagements and specific case studies, which kind of shows the development of ESG matters within specific companies. And these reports are all public if you do want to read more. So onto our draft net zero climate strategy. Hopefully this won't be new to you all. So the local pension committee agreed in November 2021 to start work on the development of a draft net zero climate strategy, recognising the risks and opportunities that will arise as a result of climate change. So this has been quite a journey of working with our investment advisors, LGPS Central, numerous workshops, as well as research and following best practice in the investment world, which has led to the development of 9 key targets and measures, which are aligned with work produced by the Institutional Investors Group for Climate Change. So we first engaged with on these measures over the summer, and we received over 1,000 responses, which were overwhelmingly supportive. We have a kind of a comprehensive engagement report, but I think just picking out the high level top target, which is net zero by 2050 with an ambition for sooner, we received over 70% support on that measure. And the other measures were largely similar in the support they received. So we took the responses and outcome of that consultation on board and drafted the net zero climate strategy. So that includes the measures which related to reducing exposure to fossil fuel reserves and also increasing exposure to climate solutions, as well as supporting the County Council's own operational target of net zero by 2030 for its operations. And there's more detail of that in the November report, but that has brought us to kind of the point where we're at now. So we've published the draft net zero climate strategy, which is out for engagement and consultation. So this is supported by recent work we had with the fund's latest climate risk reports and climate scenario analysis. And they've both shown that the fund is expected to perform better under a 1.6 degree or 1.5 degree pathway than as part of a worldwide failed transition. So it kind of just further stresses the importance of having a strategy and supporting the transition to net zero with the pension fund. So the strategy looks to set out how the fund both manages risk and opportunities, the approach taken during any decision making, as well as the approach to stewardship, engagement and divestment in order to drive down real world carbon emissions while maintaining investment returns. So the strategy also kind of sets out some of the positive action we've had since 2019, which is our benchmark year, and also recognises the limitations of the strategy. So at the moment, the strategy only really kind of covers scope 1 and 2 emissions of our equity portfolio. But we're working closely with LGPS Central to kind of develop our metrics in that regard. But a lot of those limitations are related to kind of global investor issues in terms of not having mutually agreed metrics for things such as infrastructure or property and corporate bonds. And we're also expecting some guidance from government at some point next year on governance and reporting of climate change risks for LGPS funds. But I think it was important for us to develop the strategy and produce it now. It's clear it doesn't. It's clear in the strategy that the fund has an ambition to do more, as set out with its, primary target of net zero by 2050, with an ambition for sooner. The fund will look to review performance annually towards of the strategy, and then again kind of review that at least every 3 years to see if we can strengthen some of the targets. So the full strategy is a 38-page document, and we also have an 8-page summary, which is on the pension member self-service website, and the consultation is open to the 5th of February. So I'd encourage all of you here, I know a few of you, or probably many of you are here in an employer capacity. It's really important that we also get employer views on the strategy, not only just scheme members. So I would encourage you to kind of go back to your authority and try and make sure they're responding. So I mentioned that the fund has already made some positive progress in supporting kind of environmental factors in particular. So we can see in comparison to 2019 levels that the fund is already 26% less carbon intensive, as well as less exposed to fossil fuel reserves, as well as has increased its exposure to climate solutions across its equity holdings. So that will be investments in companies that kind of have some revenue to do with renewables and those types of things. This is partly as a result of the transition of over 800 million into sustainable and low carbon investment strategies. And the fund has also made some other positive investments recently. So 55 million into the Quimbrook Net Zero Infrastructure Power Fund. So they mainly invest in solar power and battery systems. And then we've also been invested in timberland assets since 2011. And have made a recent investment in a carbon offset opportunity fund, which specifically looks to develop commercial plantations and restore natural forests on a global basis. So the fund will receive investment returns partially through sale of carbon credits, which are verified by international carbon standards, as well as through the supply of sustainable and low carbon timber materials. And there's a kind of a stat there, I don't know if you can read it, about a kind of our holdings at the moment kind of equate to sequestering about 62% of the reported emissions of the city of Leicester itself. So it kind of shows you the scale we're investing on. So RI in the year ahead. So every year, the fund has produced an annual responsible investment plan, which is built and improved on previous iterations. The fund continues to see responsible investment as vital. It's clearly here to stay and can support the transition to a more sustainable economy, whilst helping to, which is increasingly necessary to help address global challenges. So especially when we look at climate change, it's clearly a material risk, given it will impact broadly across society and the companies the fund invests in worldwide. And ultimately, if we manage the risks and opportunities posed through the development of the strategy, such as the net zero strategy, climate strategy, that will support the fund's primary purpose of ensuring the financial sustainability of the fund for its members. So that's all I was going to say. I think at this point we're happy to take questions, Chair.
Thanks very much, Kat, and thanks to Declan, Ian and Bulesh for their presentations as well. Has anybody got any questions they'd like to ask relating to the presentations? Jeff.
Thank you, Chair. I'm Jeff Lawrence. I'm a scheme member and the employee rep on the local pensions committee. I know this relates to up to March 2022, and what I'm just about to ask about probably happened after that, but I just wanted to confirm my own memory that the pension board at some point agreed to increase the amount of money allocated to pensions administration. I just wondered whether, Ian, could you just remind me whether I am correct in that, and just mention what the increase was? That'd be great. Yeah, thank you.
You're correct. Yeah, it was 0.3% of the employee contribution rate, and it's gone up to 0.4.
Okay, thanks very much, Jeff and Ian. Has anybody else got any questions they'd like to ask? No, so we'll move on to the next item, which is this is item 7, the Pension Fund Valuation 2022. I would like to extend a welcome to representatives who are joining us online today from Hymans Robertson to present this item. We're going to receive a presentation, and we've got Mr. Tom Hoare and Mr. Stephen Tart. If you would like to introduce yourself and present the report.
Thank you very much, Chair, and good afternoon, everyone. Just first of all, would like to extend our apologies for not being there in person. I don't know if it's detailed before that we missed. We had 2 flights booked. We were trying to get down to Birmingham last night, and then again at 6 o'clock this morning. But alas, we've fallen foul of the British winter. So it is a shame because we do like coming down, and we've been involved with the fund for a number of years now, and been at many of these in the past. And we know it's a great opportunity to come down and present, but then also to speak to members and speak to employers. And in particular, we know that we would normally set aside a little bit of time at the end of the AGM for more than welcome to have employers come up and ask about the results, ask about the process. And we know that opportunity has been missed today, unfortunately. But I believe through Ian, if there is anyone that would like to speak to myself and my colleague Stephen after today, then by all means, go through the pension fund. Happy to put aside a bit of time, and we can put up some Teams meetings or something like that. Thank you. So if we move on, I'll quickly introduce myself and Stephen. So my name's Tom Hoare. I'm the fund actuary at Hymans Robertson. Been working with the fund, as I say, for a number of years now, working very closely with Ian and his team to perform the valuation, which we're going to talk about today, but also just in between the valuations, there's lots of work to be done, and we've got a really good relationship there with the fund, and over a number of years, which we're really pleased to say. I've got my colleague here as well, Stephen Tart, who's been working very hard getting the valuation to where it's at, and he's going to take us through the first couple of sections here. Thank you, Stephen.
Thanks, Tom. Just quick introduction. My name's Stephen, and good afternoon. And as Tom mentioned, I'm one of the part of the team at Hymans who advise the Leicestershire Fund. So if we just jump on to the next slide, please. Okay, so I'm going to kick us off just with a high-level run-through of how the fund operates, but from a funding or a pension funding perspective. So in simple terms, money comes in. So this is in the form of employer or employee contributions. That money is then invested in the fund under the guidance of the investment advisors and the pool. And then money then goes out. I guess that's currently majority of that money is currently going to existing pensioners. But I guess there'll be some other one-off payments go to some active and deferred just now as they maybe fall into retirement or early retirement, and then I guess going forward that there'll be that future money going out as those active and deferred members become retired in say 20 or 30 years. we go on to the next slide, please. So one of the headline figures, I guess, from any valuation is the funding level. So a spoiler alert to one of Tom's slides coming up, but the funding level for the Leicestershire Fund has increased to 105% as at 31 March 2022. So the reason I mentioned the funding level is it kind of makes up a section of this diagram that you can see here. So the funding level represents a snapshot of the fund on the valuation date. And the way we do this is we take the assets that the fund holds, we take the benefits that they've earned to that same date, so the 31st of March 2022 in this case, and what those benefits that have been earned, that's what we'll refer to as the past service benefits. So that's how we get our funding level, but as you can see, that only kind of represents the bottom two blocks on the screen. There's a lot more going on here when we're doing our funding calculations. And obviously that funding level kind of only tells part of the story. So I guess the other bit of the story is members will continue to work, they'll accrue future benefits, and then ultimately those benefits need to be paid for. So they're paid for in a combination of ways. Why we're here today is to talk to you about the employer contribution rates, which is one element of it, and also there'll be fund investment returns, which will be gained in the future, and the combination of those two elements will help fund those future benefits as they fall due. Next slide, please. So you might be thinking, why do we do this? Main reason, I guess, is to calculate employer contribution rates. They'll be set for the next 3 years. And I guess as much as we do love doing the number crunching and running all the sums, we also have a regulatory requirement to do a valuation every 3 years. It's also a good time to check our assumptions. So I'll come on a little bit more and talk specifically about some assumptions in the next section. But for now, I guess what we want to say is we set various assumptions as part of each valuation exercise. Each subsequent valuation then acts as a good opportunity to analyse how those assumptions have borne out in practice. We also review, along with the fund officers, the funding strategy statement. This is where we capture any new legislation or any new fund policies that have come into play over the last couple of years. And then I guess finally, this also acts as a continual health check on the fund, just to make sure that the fund's in a good position, they're in the best position to meet all those current benefits that I mentioned earlier, but also be in a good position to pay all those future benefits as they fall due. Next slide, please. So to do this then, we take the membership data and the cash flow data for every single member in the fund. And at this point, I guess we don't have a specific slide on the data, but Ian kind of touched on a kind of high level summary of the change in membership over the past few years. I just thought I'd take this opportunity to say that I guess thanks to the fund officers and the employers for having really good data. It makes a real difference to our calculations and makes our job a lot easier. So I just wanted to say thanks on behalf of Tom and myself and the rest of the team on that one. So once we have all the data, we perform our calculations. We feed in fund-specific financial assumptions, demographic assumptions, and all these benefits are then valued in line with the current LGPS benefit structure. We take those numbers and, along with the fund's funding strategy statement and the investment strategy statement, we kind of tie those three things together, and that's what we use to then set the contribution rates for all the different employers in the fund. Next slide, please. So here we just have, a timeline of the valuation exercise, and just wanted to touch on kind of where we're at just now and just kind of detail some of the hard work that we've been working on with the fund officers over the past wee while. So you might be aware it's a pretty long process. Much of the work started way before the valuation date on the 31st of March. On the screen, we've just gone and got a summary of the main kind of action points throughout the valuation year. And then I guess just to draw attention to where we are just now. That's just down the bottom right in the yellow box. We're obviously here, I guess, I plan to stay in person to meet all of you, but here virtually today to obviously discuss the employer results and obviously take away any concerns or questions that you have. We can follow up on them if you have any. I guess just on this, it's worth mentioning that the valuation will all be signed and sealed by the 31st of March 2023. This is when the new contribution rates will come into effect. And I guess where we are just now is we've got the most of you guys will have received your employer results schedule along with the draft FSS, which is out for consultations just now. So if you have any concerns, any questions on any of the stuff you've received, if you just get in touch with Ian and the team in the first instance, then if anything needs to come through to Tom and myself, then we'll pick that up either directly with yourself or with the fund. Okay, next slide, please. So next section I want to chat about was, or just kind of take you through some of the key assumptions that we've used within our calculations. To begin with, I'll take you kind of through a high-level summary to try and give you a flavour of all the different kind of assumptions that we feed in, and then we'll maybe drill down into a couple that are a wee bit more, I guess a current hot topic, to say the least. That one's on inflation, so we'll come on to that one next. So I'd mentioned before then that we set assumptions each valuation. So if we take a typical active member in the fund, as at 31 March 2022, they could possibly have another 20, 30 years of working ahead of them. So we set assumptions for those people, things like salary increase assumptions, care pot revaluations. We consider the possibility of them going off on ill health, early retirement, or possibly withdrawing from the fund. The member, assuming they continue to work to retirement, that member then may retire. At that point, we'd make a best estimate on whether or not they might take a lump sum. They might commute some pension, so that's where our commutation assumption would come in. The member will then start to receive their pension. That will then be revalued in line with CPI each year as part of the LGPS regulations. So there'll be an assumption set on that. And then I guess that member's pension will be paid till death. And then at that point, we need to consider, does the member have a dependent pension? If they do, is the dependent eligible for a pension? And then how long might that be paid for? So as you can see, just from that kind of simple example, there's lots of different assumptions that go into the calculations, and this is done at each individual member. So it's done for every single member in the fund at individual member level. Just before we move on, in terms of changes from the last valuation, there hasn't been many significant changes across some of the stuff I mentioned there. The main one would be inflation, and we've got the next slide to talk about that one. So I guess given current spotlight on inflation, I thought it'd be useful to just spend a couple of minutes talking about the CPI assumption, so CPI inflation, and just how that varies against 2019, and I guess like what difference we're seeing in our projections. So you'll expect from all the recent news stories, all the stuff you've seen on TV, there's continual upward pressure on inflation just now. I think current levels sitting around the 10% mark, and what we've done is we've reflected this within the valuation assumption by increasing our average assumption from 2.3% per annum to 2.9% per annum, going from 2019 to 2022. So just a few things on the CPI assumption then. One important point is to note that it's a long-term assumption. So I guess if you start on the left-hand side of the chart, you can see that the 2022 projection starts from that much higher base. So that's taking into account the current higher levels that we're seeing just now, those 10% that are all over the newspapers. As we then progress across to the right and look into the future, we can see that from maybe about year 7 or so, it quickly becomes in line with the projection from March 19. And what's happening here is we do take that long-term view, and in the long term we expect that will inflation will tend towards that Bank of England long-term target of 2%. So I guess just to recap on that, we have allowed for an increase in our inflation assumption, so that will ultimately be increasing the liabilities a little bit. But then also we are taking that long-term view. So on the face of it, it's a 2.3 versus 2.9, which might not think is that much, but it's important just to think that that's an average across that 20-year time horizon. Okay, next slide, please. So another interesting assumption is longevity. So hopefully that the main aim of this slide is just to give you an idea of the different variability of life expectancies across the different regions of the fund. So this is another assumption that will feed into our calculations. Just to give you an idea of what you can see on the screen then. So the blue areas, that indicates areas of higher life expectancy. So I guess if you're, I'm not sure how big the diagram is in the room, but if you can find your house or your area in a blue section, then it's good news, I guess. On the other hand, then I guess sliding along the scale from blue down to red, red indicates slightly lower areas of life expectancy, but there's not too much red across the board on the Leicester region, which is good news. So when we do our analysis, then we look at all the traditional things like gender, salary, the lifestyle of each member, and all this analysis drills all the way down to postcode level. So it's really detailed analysis, and it's drilled all the way down to every single member in the fund. Next slide, please. So just finally, before I pass you back over to Tom, another hot topic, I guess, or buzzword in the LGPS is McLeod. So I was going to say a little bit more about this, but I think Ian covered it pretty well in his section, so I won't say too much. Just from a funding perspective, the impact is fairly small. At whole fund level, it's roughly about 0.2% of the liabilities. So in the grand scheme of things, it's not major in the terms of the pension funding perspective. Like Ian mentioned, it's a huge exercise from an admin perspective, and I know Ian and the officers and obviously yourselves have been working really hard on getting all the data that the fund need in order to make all those changes to the record. So again, thanks for all the hard work on that. And I don't think I'll say too much on the McLeod stuff, but I'll pass you back over to Tom, who will take you through the next few slides.
Thanks very much, Stephen. So I'll try and keep an eye on the clock as well. I know we don't want to run over here for everyone. So the two main outputs from the valuation, as Stephen touched upon, and absolutely everyone in the room, these would be relevant to understand. You have the funding level, which is your current funding position. We also have then the contribution rates. These are the two key things that we get out of the valuation. What we're going to talk about now is how we get there. What do we do in our models? What do the pointy-headed actuaries up in our modelling team, what have they been doing for the last 9 months? So what we've got on the screen here, this is to hopefully help illustrate what we talk about when we say this risk-based valuation approach. So the picture on the right-hand side, again, not sure how big it is in the screen in the room, but it's showing a total global equity return from the valuation date at March 2022. For the next 20 years. And as Bullesh touched upon in his address, what we know about investment returns is hopefully shown here in the picture that, yes, they are likely to be positive. However, they can, of course, be negative. And crucially, they are very volatile, and there's a really big spread of outcomes. And that represents real life. That represents what happens in the real world, as Bullesh was touching on as well. The really good returns over the past 3 years, and in the last 6 months have been negative, and that is just what happens. So instead of setting assumptions that predicts a particular given return and says, okay, perfect, these assumptions are going to be borne out in practice, we know that's not going to be the case. So what we do when we're looking at risk-based valuation is to try and capture that uncertainty that exists in the real world and try and reflect that in the funding strategy that we set for the fund, but also for each individual employer. And we lean into that uncertainty and try and embrace it and help understand what the risks are. So what we do is we model 5,000 different economic outcomes. So what we're seeing on the screen is quite lots of squiggly lines, but there's 5,000 lines there, and we do that for every single investment class that the fund's invested in. We also do it for inflation. Again, as Stephen touched upon, inflation is also now proving to be very volatile. And it's important to capture that volatility in what we do. And the reason we do this is it helps us and also stakeholders and people in the room, employers and fund officers, it helps everybody to understand the outcome and the likelihood of achieving certain outcomes, but also to recognise that there is a downside risk and that needs to be managed accordingly. So if we move forward to the next slide, what we do is we take all those investment classes, all that risk modelling for inflation and for all the different asset classes, and we build it into these 3 steps for every employer in the fund, and that this is how we go around calculating your contribution rate that we ultimately ask you to pay. So we consider what is the funding target. So it's all that stuff Stephen was talking about at the beginning. Yes, we have assets today. Yes, we have benefits that have been earned today, but that's not the end point. That's not the end game of the pension fund. We've got all these active members that Ian was talking about in his section, and we need to think about how are we going to fund these into the future rather than just setting a really short-term goal. So we consider what that funding target is. We also then think, how long do we want to give ourselves to get there? It's not fair to say to an employer, okay, the valuation's every 3 years, so we're going to do this modelling looking at a 3-year time horizon, because there's just too much volatility over a short period of time. So we set the goal a little bit further into the future. We're all long-term participants, long-term investors in the scheme, so let's give ourselves that chance to ride out some of the volatility. And then the last step is to say, well, how sure do we want to be that we're going to get there? And this is that key thing, that key balance between risk and affordability that the fund looks to strike to make sure that employers aren't paying too much, but also that members' benefits are being protected. And I've got in brackets there 75%. So that's the level of prudence that the fund builds in. And it's worth reminding ourselves as a regulatory requirement for prudence. So we need to make sure that we're achieving our outcomes in more than half the time, and so 75% is a fairly decent level of prudence, and it's about average, it's worth saying as well, in terms of what's going on across the LGPS. So certainly not an outlier there. So if we move forward to the next slide, please. And what this is now showing is what we do for every single employer in the scheme. So we take all that stuff that we've just talked about, all the squiggly lines for every asset class, and that's going on under the bonnet in our model. But what we're looking at in the picture now is capturing that and applying these 3 steps for every employer. So if you can imagine, at the left-hand side, an employer today might be 100% funded. But that is just a snapshot in time. So yes, it's important, but it's not the be all and end all. What we're more interested in is to say, well, okay, let's set a funding objective to be fully funded in 14 years time or 17 years time or something like that. And that's the target that we're trying to achieve over on the right hand side of the graph. So we give ourselves a bit of time. What's driving the volatility and what's driving these different outcomes is all that stuff we talked about, the different potential outcomes with investments, different outcomes with inflation. So in our model, let's say for an employer, we might feed in a contribution rate of 25% of pay. We say, okay, look, if this employer pays 25% of pay for the next 17 years, how likely are they to be fully funded in 17 years' time? And that's all those projections. In reality, there's actually 5,000 projections for every contribution rate that we're testing. And the goal is to be successful in enough of those outcomes in the future to make sure that we're setting credible, prudent funding plans for every employer. And that's the green padlock on the right-hand side. We want 75% of the lines to be above 100%. And that's that level of prudence. That's that 75% likelihood of success. So that'll be some of the stuff hopefully going away to explain some of the information that will be in the valuation report in the public domain, but then also in your own individual schedules. And we know this stuff is really technical, and we obviously we don't have long to try and break it down, so we do try to do that, but I can appreciate we've got a little bit of time at the end for questions. I'd welcome any questions on that if people wanted a bit of a follow-up there. So moving on from setting contributions, what do we get? What are these results? So we've done all that modelling. What is the output? So first of all, we'll quickly talk about the funding level. Because it is important. I know we downplay it and we say it's only a snapshot in time, but of course it is important, and it's really good to be well funded. And of course the position has improved since 2019. What we're looking at on the screen is the whole fund position, and in the bottom right hand corner, the funding level, we can see it's gone from 89% to 105%, which is great news. Great news for the fund. And employer positions will be similar to this. They will be varied, but they will be similar. Now, it's worth pointing out that the increase in the funding level has been mostly driven by very strong investment returns, the stuff Bhulesh was talking about. Over the past 3 years, they've been spectacular, and that's across the LGPS, which has been driving up these funding levels, which is great, and it is great news, but it is worth just reminding ourselves that is only in respect to past service. And the majority of benefits that the pension fund are going to be paying in the future is in respect of service still to be earned. This is just a snapshot, and it's important to think about, well, what is the next step? So then moving on to explain what that'll be for individual employers. Just a quick picture here to explain that individual employers will be varied. The results will be similar to what we just saw there for the whole fund. We expect funding levels will have improved, but there's a multitude of reasons why comparing your results to your neighbours, they might be slightly different. Also comparing them to the whole fund, they might be slightly different. So it could be things like funding profile, the balance between the number of active members and pensioner members, past and future service. Equally, membership experience can drive differences, things like ill health, salary increases, all these things which are individual to your organisation would absolutely put liabilities up or down. Membership profile, different gender balances can affect the contribution rate. And finally, just the current contributions that you're paying. If you're paying in more, then that's likely to have increased your funding level quicker than somebody who was paying in slightly less. And the picture on the right-hand side is just to explain some of the stuff Stephen was mentioning when he was talking about the life expectancy and this idea that everything's tailored to individual members, which in turn then means it's tailored to individual employers. And the scatter plot there is just showing a life expectancy relative to the whole fund. So if you can imagine right in the middle of that chart where the cluster of dots is, that is the whole fund average. But you can see there are some outliers. There's some employers here which have, on average, their members have lower life expectancy, which just means it's lower liabilities, and those people on average will die a little bit earlier, which is, I know it's not nice to talk about, but these are the things we do need to capture when we're setting these funding plans and looking at employer liabilities. So no two employers are the same. So moving on then to what it means for employer results. These are just some themes that you're likely to see reflected in your results that the fund has shared with you. So on the left hand side, it's some of that stuff we've just been talking about for the whole fund. Funding positions are up, so the blue arrows the assets, so that's good news. They've gone up higher and quicker than the liabilities, which is great. It's improved these funding positions, but they are just a snapshot in time. So yes, it's good to be well funded, but that is just what was in the past. So then on the right hand side, we're talking about primary contributions. Okay, this is future accrual. So all the employees that are working for an employer today, if they earn one more year worth of benefit over the next year, how much does that cost? And that costs more now than what it did 3 years ago. And that cost of accrual, that we call it, that cost of benefits building up, it's more expensive now, largely because of the increase, the pressure on inflation, which is driving up those cost of benefits. And if any employers in the room, you have your schedules, you'll know, and also from previous valuations, you'll know that the primary contributions make up the lion's share of the contributions that you pay to the fund. So that increase in primary contributions might be partially offset by a reduction in secondary contributions, which is what your current funding position feeds into. But different employers will be different, and you might see some that have ended up with broadly stable rates. Some rates might have crept up. Some rates might in fact have come down. So then just moving on, just to that exact point. So you'll find these rates, and I'm sure you've already found this for any employers in the room, the schedules that you've been issued. On page 1, you'll have the rates which, as Stephen touched on, are due to be paid from the 1st of April 2023. And this is just one example. Of course, as I say, every employer is different. So this is an example of an employer whose rates were broadly stable. And you can see there as well that the the primary contributions does indeed make up the lion's share there, that 23% of pay, and that will be up forever. And everybody in the room's primary contributions will have increased from 3 years ago, and it's just a case of, has the secondary contributions offset that to an extent that you've maybe got stable rates or otherwise. So then just finally, last couple of slides, and then open up for any questions if anyone has any. The funding strategy statement, as I think Stephen mentioned, it's out for consultation. Ian and his team should have shared that with you along with your results. A couple of comments on this. It's been through an overhaul in the last, well, during this valuation year. It's periodically reviewed by the fund, and some of the members in the room will know this because it's taken to the committee and to the board as well when there's anything material that's changed. But the new funding strategy, we've tried to streamline it with help of the fund officers as well, or it's the fund officer document, and we've been feeding into this, and there's an improved structure and layout, and the idea was we want to improve the accessibility and make it more navigable, and bringing out some of the key policies into appendices so it's easier to point, whether it's an academy or something like that, and say, look, there's a separate academy policy, go and read everything in that one standalone appendix document, and you don't need to read the 40 pages that preceded it unless you need to. So that is out for consultation. Have a read at it, feed in any comments that you've got back to the fund, and they'll in turn sort of include us in those conversations. So then just moving on to the last couple of slides here, the timeline, which I know Stephen put this back up, is just to bring it back round full circle to say that we have done a lot of work, and thank you to all the officers that have fed into this, and to Stephen and the rest of the team here at Hymans. We're in this consultation period. A couple of other things then to follow at the back of this, which at the bottom of this chart here, so we can see that the funding strategy will be finalised in Q1 next year. The final valuation report will be finalised and be brought before committee, just sort of crossing the T's and dotting the I's, and then most importantly, these new rates come into play from the 1st of April 2023. So there's a period between now and then where by all means you can consult on the funding strategy statement and consult with the officers if there's any questions around your specific results. And very finally, what do you need to do next? It's quite simply these three things. So read your schedule, which I'm sure you have for any employers in the room. Review the updated funding strategy. As I say, we have tried to make it easier to read. We know it's not a pleasant document to read, but it's a very necessary document to set out the rules about how the fund manages its money and manages its employers, and this idea of risk versus employer affordability. And there's a lot of regulatory and statutory stuff that's in there as well that has to be in there. But as I say, we've pulled out a lot of the information which is really particular to employer groups, and hopefully signposted it in a way that makes it easier for you to engage with that document. And then lastly, just talk to the fund and via the fund to ourselves if you've got any questions or anything that you want to flag up. So that's all that we wanted to say today. Apologies again that we couldn't be there in person. It's a real shame. We did try our hardest, but I think also with the rail strikes, it just wasn't possible to get an alternative route down. But welcome any questions if anyone's got some today.
Thanks very much, Tom and Stephen, for your presentations, and we fully understand the reasons why you couldn't be here today, and thanks for trying so hard to get here. Has anybody here got any questions they'd like to ask? It seems no. So, yes, Graham.
Yes, thank you, Chair. Thank you for that presentation, Tom and Stephen. So I'm Jeff Lawrence. I'm an employee rep on the local pensions committee, and we've got a report coming to this meeting just after yours, I think. But in that, we sort of acknowledged as employee reps that the performance of the fund is really improved, as you've just stated, during the course of the last 3 years, and now is fully funded as we describe it. But I'm just very conscious, and the employee reps are very conscious that that was at a point in time of 31st of March 2022, and obviously quite a lot's happened in the world since then, and so that total funding level is only at that single point in time, and obviously the markets that we're investing in continue to fluctuate, doing what is a very turbulent period for the global economy for all sorts of reasons. Given that pensions require a very long perspective, as everybody's been saying at this meeting, our view as employee reps was that the fund should be careful about relaxing employer contributions too much based on just that single snapshot in time. Is that an analysis you would concur with?
Yeah, absolutely, and it's a really good question, and actually the period of time since evaluations is a really good example of what we're trying to do with the help of the officers and implementing this risk-based approach where I would take this long-term view, because what's happened is absolutely just something that's built into our models. We know that there's going to be these periods of uncertainty and periods of volatility, and as I say, we set this long-term approach with that in mind, and we deliberately don't look to take any knee-jerk reactions to news that is good or bad. And I think the good news leading into the evaluation is probably an example of that, where, of course, we're very mindful of employer affordability, particularly in the kind of current climate. But at the same time, it's also important to recognise that some of these things are cyclical and periodic, and yes, we were in a good funding position there, but stability is the key, and some of the members in the room as well will know this, that the bigger employers in the fund, which make up about 70 or 80% of the contributions that come into the fund, they are set with that exactly in mind. We set them on a kind of different path that leans in directly to stable contributions, regardless of what the economy is doing, and this idea that they'll only go up or down by a really small percentage in any given year, and that protects the fund, and also actually protects employers as well from big sharp rises in the future.
Okay, thanks very much. Thank you once again. Thank you, Tom and Stephen, for your report. Much appreciated. We're going to move on now to item 8, which is the Local Pension Board Annual Report. A report has been compiled by the Local Pension Board, has been included in the agenda pack for today's meeting, and was published online with the agenda papers. Mrs. Rosita Page, Chairman of the Local Pension Board, will present this report, and welcome, Rosita, and over to you.
Thank you, Chairman, and I'm trying to keep it very short and succinct, because most of the work we do and whatever was explained by Ian Howe in his first presentation, so I shall avoid doing any repeat, and I will just say that I am extremely pleased to present this year's Pension Board's annual report, which, of course, you realise it outlines the breadth of the work undertaken by the board through the year. The key objectives of the board is to assist the administration to secure compliance with regulations and legislations, as well as to ensure the effective and efficient governance of the fund. Throughout the year, we have scrutinised the fund, and we have no concerns to raise on the fund or its administration. The report sets out some key areas we have looked at, but as I say, Ian covered all of the angles earlier on. So I will conclude by expressing my sincere thanks to my fellow board members, all of the officers, for the contribution to our meetings, and I wish everybody a very Merry Christmas. Unless there are any questions, I take my leave. Thank you very much, Chair.
Thank you, Rosita. Has anybody got any questions? No. Okay, we'll move on to, thank you, Rosita. We'll move on to the next item, which is item 9, report of the Local Pension Committee Employee Representatives. A report of the committee is on the agenda today at pages 115 to 116. I don't know, Graham, do you want to add anything further?
Yes, I will, Chair, thank you. Just briefly, really, just to say, I've already mentioned one thing I was going to talk about, so I won't repeat on that. Just on paragraph 6A of our report. So this is the report on behalf of myself, Nick Booth and Ashley Wilson, who've been attending local pensions committee and investment subcommittee meetings this last 12 months. And really, just to reiterate what it says here, that as employee reps, we've sought to support and influence the scheme, the committee, in its efforts to reconcile increasing climate-related risk that might, for example, be associated with investing in fossil fuel producers and companies that are heavy users of fossil fuel products, for example. But we sought to sort of influence the fund in its efforts to reconcile that kind of risk with the fiduciary duty to maximise returns from investment through the development of the net zero climate strategy. So that's the balancing act, and that's, we've welcomed the development of that net zero climate strategy because we feel that's a good way to sort of really articulate and decide how to take things forward in balancing those two things. So, what's been interesting for me is personally is the training that I've received through being a member of the employee rep on the pensions committee is in the last 12 months has really demonstrated to me that the pensions industry in general is rapidly coming to the view that a shift to a more environmentally sustainable form of investing doesn't need to come at the expense of the continued ability of the pension fund to pay out pension benefits. So I think that's a real key thing for us, I think, going forward. And in connection with the net zero strategy that's currently out for consultations, obviously I would encourage scheme members to participate in that consultation. I think Kat gave you the link earlier on in her presentation, but it is very important that scheme members' views are taken account of in that consultation. It is now, in contrast to the previous consultation, which was on some specific points, this is now laid out in a format with all the background information that feeds into the climate strategy. I think it's kind of something that's readable and understandable. There's a lot of complex language, obviously, and concepts in this world as we've seen today. But I think that's very important that as many of us as possible comment on that by the 5th of February next year. I think that's all I really wanted to add, Chair. Thank you.
Thanks very much, Jeff. So the next item on the agenda is the appointment of scheme member representatives to the local pension committee. We've received one nomination position of scheme member representative on the local pension committee, therefore no ballot is required. Mr. Clive Pitt will therefore be appointed to the local pension committee for a period of 3 years. The current staff representatives elected to the committee are therefore Mr. C. Pitt, newly appointed for a period of 3 years, Mr. Lawrence to remain a staff representative for a period of 2 years, and Mr. Booth to remain a staff representative for a period of 1 year. So that's for information. The next item is item 11, appointment of scheme member representative to the local pension board. We have received one nomination for the position of scheme member representative on the local pension board. Therefore, again, no ballot is required. Mrs. Ruth Gilbert will therefore be appointed to the board for a period of 3 years. The current staff representative elected to the board are therefore Mrs. Ruth Gilbert, newly appointed for a period of 3 years, Mr. M. Soroya to remain a staff representative for a period of 2 years, and Mrs. C. Fairchild to remain a staff representative for a period of 1 year. There is also a vacancy for the reserve scheme member representative. Please use the contact details on the agenda front sheet if you're interested in applying for the role. So, moving on to item 10. Any other urgent items? As I mentioned earlier, there are no urgent items. So, item 11, to arrange the date and time of the next annual meeting. I will move that offers be requested to determine a an appropriate date and time for the next pension fund AGM in 2023 and publicise this date on the fund's website. Is that agreed? Yep. Thanks very much. It just finally remains to thank everybody for their attendance today, officers for their presentation, members, Jeff, for your questions and highlight, and I would echo that a tremendous amount of work has been done on the net zero carbon strategy. Please take the time to respond to the consultation, and I wish you all a Merry Christmas and safe journey home. Thank you.